Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. Welcome Jeremy and Dom from DPR Accountants, our first guest at episode 51 in the studio.
Welcome,
Thank you.
Dom.
Yeah, good to be here. Thank you.
So today we're going to be discussing, property in your own name, gearing, loan and tax considerations. So it's going to be a 3-part accounting series, I would call it. So we are going to be sharing some diagrams and spreadsheets so anyone can view this on any of our podcasting platforms. But let's get stuck in. So property in your own name. Where do you start with that, Dom? Like a lot of clients come in, you see many clients.
Yes.
Is that the main structure that you would normally see for individuals?
Yeah, for sure. It's by far the cheapest and easiest one just to set up. I'm an individual. I just go off to the bank, get a loan, buy property. It doesn't involve an accountant. It's just a couple of pages in your tax return, whether it's positive geared, negative geared. It's very simple.
And I think in the next episode that we're going to be pretty heavy on the tax structures. But do you want to go into a bit more detail, I guess, with property in your own name?
Yeah. So they just separate between the entities, and so people are natural people. And so the easiest version is that as an individual, you'll just own 100% of a property. Easy one. As soon as you bring another person into the equation, doesn't matter what the split is, could be 90-10, 50-50, common ones like that. That's deemed as a partnership at a lot of levels. So you might not think that you've created a partnership, but really you own something with somebody. It's a partnership that owns that. And that becomes an important point for land tax later on. So the two main points when you own with property, with another person, is there's joint tenants and tenants in common. I'm sure a lot of people have heard of the two terms. So the joint tenants is the more common one, sort of your mum and dad type arrangement, where they have you together, you own the whole thing. The more legal point of that is that when one person passes away, the ownership goes automatically to the other person. There's no will has to execute for that to happen. It's just an automatic transfer. The tenants in common is more of a business type arrangement where you have two friends or a couple of friends that go in as tenants in common, and that's where you can actually set percentages. So you can have 50-50 tenants in common, or you can have different percentages, 60-40, 75-25, or three people at 33, 33, 34, that sort of thing. And the thing there is that you actually own a portion at that stage. So with your will, you can actually assign your portion to go to somebody else. So it doesn't automatically just go to the other people.
And there's no stamp duty on that, is there? So let's say it's like a 60-40. Jeremy and I are 60-40 ownership, and something happens to Jeremy. Would that come over to me right away if it's not in his will? Would I automatically...
If you were joint tenants?
Joint tenants.
Yeah, no, it'd normally transfer across without stamp duty.
Okay.
Upon the death of someone. Yeah, it's a cheap way to get property. No, I shouldn't say that.
But I would see it typically with a lot of clients, and I'm sure that you would see it too, is it's like a couple tend to have these percentage splits. So for example, like let's say one of them is a high income earner, someone else is a low income earner, or maybe she's going to go on maternity leave or go down to 3 days a week.
Yep. Then
you'd structure it percentage-wise differently, because a lot of people go, I'm not really sure what percentage I should have. And I always say talk to a tax accountant when you do get to finalising the actual property settlement.
Yes. Yeah. So once you set the percentages in a tenants in common arrangement, if you're going to move percentages, it'll cost stamp duty unless you're talking about deceased estate type transfers.
But for a lot of investors, they keep it simple. They might have 1, 2, 3 investment properties a part of their journey, and they'd keep it pretty simple. I guess the balance is when they start becoming positively geared or cash flow, which we'll talk about later, is you got to take into account the tax consideration. So it's that benefit, isn't it? It's like, well, early on when you're accumulating, you're claiming negative gearing, and then as you go further down the track, it's a bit of a balancing act.
Yeah, and then ultimately there'll be negative gearing turns positive gearing, and then eventually there's a capital gain. And so you own 90% of something. Yeah, you get 90% of the negative gearing, but then you also get 90% of the capital gain at the back end.
That's it.
You've got to set the arrangements to suit the ownership.
Yeah, interesting. Okay.
I mean, one of the stories that I had was with my grandfather's place when he passed away, and the lawyer, I was only young at the stage, and the lawyer that set that up, speaking to my dad and my uncle, he set it up as joint tenants, and nobody even really paid attention to this. I don't know whether the wrong question was asked or what the case was, And it wasn't until I was a little bit older and I said, hey, that house that you've got, with Uncle, how's that owned? And we looked into it. It was joint tenants. And I thought, okay, so if something happens to my dad, my cousins inherit what's the house. And if something happens to my uncle, then we inherit that. And I thought, I don't think that's the way it should be. So off we go to the lawyers, and you actually have to break the joint tenancy and convert it into a 50-50 tenants in common arrangement. And that can be done. And there's no stamp duty involved with that. It's just a nominal amount. And so now each of them own 50% that they can then describe what happens to in the will themselves.
But if it was like a 70-30 split, couldn't you have in your will, like let's say I own 30% of the portion, something happens to me and I can give it to one of my family members if I've got it in the will or not, if that makes sense?
Only if it's a tenants in common arrangement. So joint tenants is automatically assumed 50-50. Well, it's not 50-50, it's together you both own this thing. Everything, it's deemed 50-50 just by default. You don't set that percentage. It's just, together we own this, it's therefore 50-50. There could be 3 people as joint tenants, and that's a third each.
So everyone, so joint tenants is a 50-50 split.
For 2 people.
And tenants in common is just like a percentage split change. So it could be 90-10 or 80-20.
Yep, you determine what the split is.
Okay. Another thing I would also see is that siblings or friends investing together. Now, it's quite rare, but I would see it as they do it because they want to get into the property market a little bit sooner, or they think, it's a great idea to accumulate our portfolios a lot quicker because we've got 2 incomes, but then you've got borrowing issues and they don't have a strategy. They've got nothing in writing. So everyone's on their own journey. And then after they buy that first one, they're going to find that their hands are going to be locked for that investment property 2, 3, 4. Yes. So these are questions you need to be talking to an investment savvy accountant, potentially someone that knows their stuff.
Yeah, someone that's seen it sort of go wrong before helps. Because generally those situations, the first one's very easy. So, it's easy when 2 of us go buy a property. What happens when you go to buy the second one? Even if you want to do it with somebody else or even on your own, the bank has to look through that. Well, you're in business with this other person. You've got a property. You've got loans. We've got to make sure that if something happens to the other person, you can service them yourself. And all of a sudden, this other person's finances become part of your next loan application for something totally unrelated. So it does. The web opens up very quickly.
And lending can be a lot trickier. I know there's not a lot of lenders will assess 100% of the lending, even though you might have 30% ownership, for example. I know there might be 1 or 2, but you don't want to hold yourself back from accumulating your portfolio. So look, a strategy could be if you don't have a lot of money, the plan might be get into a market, get out maybe after 2 to 3 years, get that capital growth, and then they take their money and then invest individually. That's the way I would see that it would work really well. If you're both restricted with cash and you want to get in, you can get 50, 60% growth within a 3-year period and then go on your own journey.
Yeah. If you're going on your own journey, that's the way you do it. Unless your journey is to tie yourself to this person, let's jump off the cliff together forever. Then it can work, but you're tying yourself together.
I find a lot of people don't actually have a plan or a strategy. They might see something on YouTube or Instagram and they just, there's no strategy. Just buy 7 properties and make it sound so easy, but it's not.
Go out and buy 7 properties.
Yeah. All right. What's next on the list?
Okay, so one of the topics I wanted to cover was individual income tax. So now it's just important to remember that so out of the 3 of us, I'm not the one that makes you money. You 2 are the guys that make people money. I'm the one that just makes sure they try and hold on to it as much of it as possible. So that's one thing I'd like to try to remind people is that tax doesn't make you rich, or not paying tax doesn't make you rich. It just means you get to keep more of it at the end.
Yeah, good point.
Yeah. Okay. So individual, that's an easy one. So you're an individual person, you go and buy a property, 100% of the income is in your name, 100% of the expenses are yours, and you have to declare the positive or negative at the end of it. Now, what a lot of people don't understand, or maybe may not understand, when you buy property with somebody, there are certain items that have to be split according to the ownership percentage. So, but then there are some things that don't need to be split according to the ownership percentage. And so the classic one is interest. So if we buy a property 50-50, the income that property makes, we have to split 50-50. Like we have to declare it as 50-50. The council rates, water rates, insurance, gardening, agent fees, that has to be split 50-50. But there are a handful of expenses that don't have to be split according to the ownership. The classic one is interest. So on the 50-50, You're cashed up. You buy your half in cash. I go to the bank and therefore I will have interest. So I'll carry 100% of the interest cost on my loan on my half. Your half might have no interest. So interest is something that doesn't have to be split according to ownership. The one that a lot of people don't necessarily know about is repairs and maintenance. So you can actually put it forward the argument that, well, I went and fixed the hot water system and you didn't, so I get to claim the repairs and maintenance on my half. That's something that is not necessarily have to be split according to the ownership. I've seen that done before. And land tax, that's another one. You might have multiple properties, so you have a higher land tax bill. I only have the one, so I have a lower land tax bill. So land tax is not split according to ownership. And depreciation, if I've gone and bought something expensive and I depreciate it, then like an aircon, I paid for the aircon, I put that in, I claim the depreciation on my portion of the income. So that's something that not a lot of people necessarily know. There are expenses you don't have to split.
I think, the ideal scenario is after you buy a property, you have everything go to the property manager. I know I do. So typically you would sort of have that arrangement with whoever you're going 50-50 with as an example, and you'd sort of split all the costs. Ideally, that's what you want to do. But I can imagine there could be headaches that might arise. I don't want the air conditioning. I don't want to spend that money. So that's where I think you have to have a lot of trust in who you're investing in.
Yep, that's right. Yeah. The other topic I wanted to cover off was now capital gains. So a lot of people know about the capital gains discount. So as an individual, or whether you're in individual ownership or partnership, or two individuals owning as partnership, the capital gains that applies, as long as you own it for more than 12 months, you get a 50% discount. And we've got an example to go through this at the end. So in the individual case, you own it by yourself, the 100% of the gain is yours. The gain gets halved, assuming you've owned it for more than 12 months, and it just gets tacked on to your income. Now, if you're working in that year and you earn 120 grand and you make a gain, the gain just tacks onto 120 grand and you pay tax at marginal rates. If you time it that you're not working in that year and your starting income is zero, well, then that capital gain actually starts from zero, and so you get the benefit of the tax-free threshold and all the lower income tax rates. So you pay a lot less tax.
Yeah, it's a good point, because this is, again, comes down to strategy. Because again, I've seen so many scenarios, and it could be like, ideally you go through that accumulation phase. You've got your portfolio, and you'll hear so-called experts out there say, "I'll just sell a property and pay off your debt." But what they're not taking into consideration is all the capital gains that they would have to potentially pay. So you have to factor that into your numbers. The way I would look at it is, well, if I was going to sell down a property, it'd be in a year where maybe I'm not working, or I take a gap year, and then I offload that asset. The capital gains will be minimal. Then I can utilize to pay off or move that money into all my offsets, and I've got the cash buffer there to live off if I need to. And then I'd wait till I get to maybe 60, and then it's like that bit of a balancing act. So that's why cash flow management and strategy is really important. But big consideration in that capital gains, because Jeremy and I, we've spoken a lot about going into markets, and there's a lot of markets that have had negative growth or zero growth the last 3 years. But if you sort of sold, like when it had its big run, took that money and went into another property, you have to do your numbers and factor capital gains, which is a big one, isn't it, when you sell a property?
Yeah, if you're fortunate enough to have capital gain, that's usually, if you've got everything right, that's usually your biggest expense in selling. It's CGT. It's not the agent's commission. That's nothing. Yeah, that's CGT. But you can also pick the year that you sell your property and sell some of those shares that have plummeted in value to sort of offset that.
Yeah, it's got to be a bit smart. And it's good to sort of understand, instead of just going to like a financial planner or even accountant or a property advisor, it's good for you to know, because at the end of the day, it's your money and no one's going to look after your money like yourself.
Yeah.
Obviously, there's experts out there that put their clients first, but it's still good for you to know. That's what I'm trying to say.
Yep. And that's one of the points that I make when people talk about selling their property. We work out what the gain's going to be, the discounts that could apply. I then also ask them, hey, do you have any potential carry forward capital losses that you haven't claimed? Have you owned some shares that you sold at a loss and you forgot about, or have they got something currently sitting in a portfolio? Like they might have some managed funds that are down, or the classic is, oh, well, I put $8,000 into crypto and I don't know what happened to it. It's pretty much gone. Well, you've actually got an $8,000 loss that we could realise. This is a good year to use it up against the gain of the property.
Yeah, okay. Could you go to the ATO and say that? I had 8,000, I don't know where it's disappeared to.
If they have actually gone down to zero, yes, yeah, you say I've realised. If you realise the loss,
then you got proof of it.
Yeah.
Okay.
Yeah.
Because it's a good point. I had a client that they bought a property unit somewhere in Sydney, and the last 10 years it went backwards by about 120,000 or something like that. And they've sold it, and they've got this massive carried forward loss. But now they've got another property that they're going to have a gain where they can offset a lot of those losses. And that unit that they've got at the moment, there's no real growth with the amount of supply and, a lot of units within the complex. They're better off offloading that and then just starting from scratch.
Yes.
Again, because I always come down to we invest in property to get that growth, especially while we accumulate. But a lot of people, as we know, talk about cash flow. It's time and time again. Cash flow is a big thing, but always bring it back to your personal circumstances. People don't know what their monthly surplus is.
Mm-hmm.
So,
yep, agreed. Now, land tax. So land tax is the interesting one. So I'm going to gravitate toward around the New South Wales land tax because that's the one I'm most familiar with.
Mm-hmm.
So everyone's got a threshold of not everyone. Most individuals, companies, super funds have thresholds. Discretionary trusts don't get thresholds. There's land tax is one of those ones where if you get it wrong, you can build a couple of $1,000s quite easily into your costs just of owning a property. And I've got an example where we own a property jointly with two people. How land tax apply, because that's not something that a lot of people tend to work through a lot.
Mm-hmm.
So if you can bring up that spreadsheet, please, Damo.
And with the trust, I think it's more on our next episode that we're going to do, but a trust, is that tax right away land tax or not?
Yeah, so discretionary trusts in New South Wales, they have a zero threshold, so they pay tax from first go. So the other sheet, sorry, the land tax one.
Land tax.
Yep.
Perfect.
Yeah, so in this scenario here, I've got two people, person A, person B, and they own 50-50 a property. Now, whether it's tenants in common or joint tenants, that actually doesn't matter. It's just seen, the two arrangements will be seen as 50-50 the same way. So property A owned half-half, property B is under person A only. And what actually happens in this scenario, if you get all your right registrations done up front, the Office of State Revenue, or the old name, the Service New South Wales, they'll actually firstly assess the partnership. And they'll say, hey, this partnership between person A and person B, they've got a property worth $1.4 million. And that is actually over the New South Wales threshold of 1075 by $325,000. So the partnership actually receives an assessment at 1.6%. So you've got your base tax is then the $5,000. I've then got the levy. So as soon as land tax gets involved, they charge $100 as a base price. So you receive an assessment for $5,300. Now that's actually issued to the partnership. They don't send anything to the individuals at this stage. The partnership receives an assessment for $5,300. Now in this case, person B would feel a little bit ripped off because they will go, well, hang on, I own half of a 1.4. Don't I just get assessed at 700,000 and I'd be under the threshold? And that's what a lot of people would think would happen, but that's not what happens. They assess the partnership 1.4. And that's the primary assessment that gets sent out. Then what happens below that? Then we get the secondary assessments. So if you can scroll down a bit, then what they'll do is they then assess each person together. Individually. Person B is probably the easiest one to go through here. They say, person B, okay, so now you've got $700,000 in land value A. You've got nothing of land value B. So now we apply your threshold. On your own, you're below the threshold, so you actually get no more to pay. That's where it stops there for person B. So person B is effectively paid half of the partnership assessment at this stage. Person A, they get the $700,000, the half value of the property. They then have that $1.51 million property in their own name. Apply the threshold. They're in their own name over by 1.1. Apply the 1.6, and then you got the $18,000 base levy. Then we have the just because $100, add that on, so it's $18,100. But you're going to take into consideration they've already paid some land tax up in the partnership up above, and you'd think it could be as simple as, hey, do I just take half of that? And no, they haven't made it quite that simple. It can be, but it might not be. So if you scroll down, there's actually two ways that they'll work out how much of a discount do you get. They work out your deduction, and there's two ways to do the deduction. Number one, the easy one, how much have you already paid, which is half of the primary assessment, and that's that $2,600 is half of the $5,000 number. The other way they work out the deduction is how much of the taxed property makes up your total holding. So the property that's already taxed is 700.
Mm-hmm.
Your total holding is 2.2, including 100% of the ownership. So it's 31% of the total owning has already been taxed.
Mm-hmm.
So the 5,700 is 31% of the 18 grand, should be, yep. And so they say, all right, and then they take out of the two options, out of the 2,600 or the 5,700, which one of those is smaller? So, yep.
5,300, that's right, yep.
Yep. So between the two options, deduction 1, 2,650, deduction 2, 5,700, which number is smaller?
Mm-hmm.
Of course, the 2,600. So that's what they take off the 18 grand, and then the person A would get another bill for 15,450.
Okay. So they just like to do the sting.
They do. And they give it two options, and those percentages move wildly depending what other property you've got, the value of the other properties. And that's it. But they always work out which one gives the smaller deduction, and they claim it's to say that you're not being double taxed. In my opinion, it's true. Maybe person A is not being double taxed, but in this case, person B, they've actually paid land tax on something that on their own would just be under the threshold.
Mm.
So that's something, I guess, the takeaway is to consider if you are partnering with someone, and partnership sounds simpler than a contract. You just buy an asset with someone else.
Yep.
That's something to be aware of, that you might be triggering land tax by combining your powers.
Yeah.
Would another example be, like where I would see this, where it'd be a bit more common, let's say you've got an inheritance with family, and their properties are in Sydney or wherever it might be, and they're worth 2, 3, 4 million, and they think, oh, we're just going to keep it. We're going to keep the properties, and then when it becomes an investment, or they might have joint ownership, and this is where this would be applied, because you think starting out, not many people are going to go buy property for $1.4 million. They might be starting at a lower price point. So this is quite rare, but if you receive an inheritance and you decide to hold on to that, do you get hit right away that first year? Because I think what a lot of people would do is they might not sell that inherited property right away. I think there's like a 2-year window. Is that right, where capital gains can be avoided?
As long as the property was the deceased person's main estate, main principal residence.
Correct. But if they turn that, let's say, for an investment property, a couple months after it's rented out and it's worth $3 million and it's a 50-50 split, well, the capital gains is going to be...
The capital gains, the land tax.
Everything starts getting injected.
It all kicks on. As long as because you can only claim one house as your principal residence.
Correct.
Any other properties start going up over that threshold number.
All right, perfect.
Yeah, so in this instance, the way that I would look at this, I'd say person B might have think, oh, I've done the right thing here. I've gone and bought a property worth a lot more than what I could have afforded on my own.
Mm.
So, but in inheritance, if they could have bought a property with $700,000 of land value by themselves, they would have paid zero land tax. But buying $700,000 of land with somebody else, 50-50 and a $1.4 million of land value, all of a sudden they're worse off by $2,600 a year.
Do you see this often?
Yes.
At these price points, like 1.4, like do you see where this person B could have, I think the price point's the big one for me. Do you see this a lot where they could have bought on their own, but instead now they've gone 50-50 with someone, and they have this land tax liability where if they went on their own, they wouldn't have.
They would have the full threshold. Yeah, look, it's something that sneaks up on you because you're not over until you're over, kind of thing. Now those numbers are a little bit higher, but at 1.1 million in Sydney, your first house might be free. Every house after that, you pay land tax. So it's not hard. And then if you then own, and if person B, just like person A, if you own something small, even a unit could start dragging you over if you're already sitting at 700. It wouldn't be too hard.
Or depending if you go to like maybe Bondi or Maroubra or Bronte or these areas where units can be in the millions, it's something that you need to consider.
That's right.
That threshold, Dom, is that indexed or is it static?
It is indexed. However, the lovely government left it unindexed for 1 year, and what they also do, they work on the value of general. They give 3 years, so 3 years of average land value, and then that's a rolling figure. So, but the threshold is normally indexed, but they've left it unindexed just so that more people get captured.
Do you see a lot from the ATO? So, like, let's say you've got two investments in New South Wales and you're just below that, or let's say you're over the threshold for some reason, you got 3 properties and you're way over, and let's just say you decide to move into one of those properties as your owner occupier, who do you tell that to? Like, do you go to the ATO and say, hey, I've moved into this owner occupier, or is it because it's on your tax return, it's not an investment anymore, you won't receive that land tax bill? Because I can imagine I've heard of instances where people have received a land tax bill assuming that they're still that property is an investment property and not their owner occupier anymore.
Yeah.
So do you see a lot of those mistakes done by the ATO?
It's not governed by the ATO, so it's Revenue New South Wales.
Okay.
Yeah, so they're the people that you need to advise. So land tax it's taken, the snapshot is 31 December. So it could be an investment on the 29th of December and you move in on the 30th. So on the 31st, it's actually your home, as long as that's really happened. They would issue an assessment because they don't know any better. You then fill in a form or put in an exemption claim saying that it's your principal residence. As long as that's your only principal residence, then they'll amend the assessment.
Okay, and another point with the land tax, just for all our listeners, is it's different in every state. So you can type in land tax Victoria or land tax South Australia, whatever it might be, and you'll see all the different thresholds. So I think these days for investors, they're diversifying a lot, going borderless and sort of spreading out that land tax risk, which is, I think, a smart move, but also going into different growth markets. Do you see actually a lot of investors that come to you buying their own backyard, like New South Wales, or do they? Because if you don't know, you just think, okay, I'm going to buy in Parramatta because that's where I live, for example.
Yes,
I live in Doncaster in Melbourne. I know it because I know that coffee shop, and that's how they talk about. They've seen their property have growth, so they're automatically an expert.
Yeah, so that's something we've seen a lot of change more recently, where people have been opening up a lot more to using buyer's agents has sort of exploded, and so you see a lot more property purchases coming through in different states. One of the advantages of that straight away is that 2 places in New South Wales you start being over land tax, but if you buy one in every state, there's sort of 6 or 7 you could get without paying almost any land tax.
Helps your cash flows out. That's the big one.
Yep.
Perfect. So now we want to move over to our example. Is that what we want to do?
No.
No?
So now the other thing just with borrowing that I wanted to mention was, even though you might have you've got your own individual deposits and individual serviceability, a lot of the banks will do cross guarantees, so that you're responsible for the other person's debt and they'll be responsible for your debt. Is one of the other things I want to just bring up. Is not a lot of people necessarily know about that. They think, I'm responsible for my debt, and you go, yeah, but if your investment partner runs away, the bank's going to come to you for those extra repayments.
And it can also, again, with a lot of the lenders, I know there might be 1 or 2 that you can maybe get away with this, but typically, like, they'll assess you when you're doing your borrowing capacity. Let's say, okay, I've gone 50-50 with you, Jeremy, we've bought a property, but now I want to go buy my second property on my own. And they will take on all the debt, but they'd only take 50% of that income for serviceability. So that's where it can really hold you back. So you're very limited by lenders. And as we know, every lender has different serviceability. So you want to make sure your options are open while you're through that accumulation phase.
Yep.
Yeah, so with all these negatives of partnering up, like the lending restrictions, the land tax, what would be the benefits of having a partnership with someone?
I would say getting into the market sooner, that would be the big one. So like, let's say you've both got 50,000 each, instead of buying something at a lower price point, maybe you can push it a little bit higher. That would be my biggest, that's the only reason I would think about doing that, but also having a strategy in place where after 2 to 3 years, you get that capital gain, we make our profits, and then we decide to do what we want with that money down the track. I can't think of any other benefits besides that.
Yeah, I see a lot of people come together. It's because one person will have a deposit, but not necessarily the income, and the other person will have the income, but not the deposit. Right. So you bring the two together, and so all of a sudden now they can actually together they can buy. Individually they couldn't buy anything, but together they can buy something.
I think it'd be important to have something in writing too. If you are planning on going down, is sit down and go, okay, what's the plan with this? And there is something actually in writing, because I can imagine there'd be a lot of instances where, once you involve money with friends, it can be really tricky.
Yep.
Yeah, and it can start off all perfectly, but I think what you were saying about you want to go your own way after a couple of years, I think that's really good advice for any sort of partnership, because everyone's circumstances change. And the longer that you have this partnership, the more likely circumstances are going to change. So you have a short-term joint venture. Get in, get out.
And I think it starts you off because that's really the hardest thing with property investing is just trying to get that first property and trying to get that first injection to be able to accumulate. Once you get that first one that grows, it's a lot easier because then you can start building on the back of that. Where it really hurts is buying an asset that's underperforming and it just holds you back completely.
Yeah.
And do you see that a lot with a lot of tax returns? Like you might look at someone's portfolio and just obviously you most probably don't ask, well, how much did you pay for it? What's it worth now? That's something that I would do when I'm looking at someone's scenario. Go, okay, well, you got an underperforming asset. Maybe you should think about offloading that and restarting because you've got all this allocated cash doing nothing whatsoever. But then I hear the argument, oh, it's giving me $30 a week. It's fantastic. Well, it's like the property's not, it's true. The property's not performing.
$30 a week.
Yeah.
I just made that $30 up. But they think because it's giving cash flow, it's fantastic. But you have to look at the ROI on that property.
Yes.
Yeah. If it's all for cash flow, that's a retirement scenario. That's not an accumulation scenario.
Good stuff.
What else? What's next, Dom?
So what I've put together is a little special adventure.
Alrighty. I like special adventures. Let's go.
And it's all around borrowing because for me, the key around borrowing, it can make a big difference. And so getting your borrowing right, as well as getting your structure right and your percentages right, getting the borrowing right, and this one I see all the time because a lot of people just go to the bank and they just do the very simple version. So I like to say, okay, what if we pull this loan apart into its components? And I want to show just the power of something like this. Just an off the cuff accountant comment can save you a couple of grand and cost you not that much. So what we've got here, I've kept all the variables the same. So we've got two people, they bought a property, 50-50. Across all scenarios, the income is the same, all the fees are the same, so the total expenses are the same. Down to that net rent figure, everything is the same across all these three scenarios. Now, the two scenarios I'm going to compare is one where the two people go to the bank and they get a joint loan. So they've got a single loan, and that's for $650,000. And when we come to claiming their tax return, we allocate that 50-50. We've got a single loan. We can't actually do anything with that. We can't split that any differently because it's both names that way. And what I'm going to do is show the difference of now, what if these two people, instead of getting one loan at 650 for both of them, what if they each got a loan for 325 each? And we'll just do the comparison. At the beginning of the comparison, the difference is nil, but later on we'll see the effect. So working through the blue box, so the loan 650, at 6%, you've got a $19,500 interest deduction each. So both of them have a negative gearing of almost 10 grand. Now the difference between person A and person B, and this is kept the same again, they're on different incomes. So someone's in the 39% bracket, and the other person's on the 18% bracket. So the tax benefit associated with having the negative geared property, the total there 5.5. So the person A gets 3.8, person B gets $1,800. So that's actual cash tax refund or direct tax benefit. So together they get a $5,500 tax benefit. Now, moving forwards, eventually this loan's going to get paid off one way or the other as you progress through life. The loan's now down to $350. So keeping everything the same, $350. If that loan is now split $175 each, or it's the same single loan, our interest is now $10.5 grand each. So we've both dropped our negative gearing. So we're still negative, only just. It's heading towards flat. Now, same different tax benefit, the tax rate. So the tax benefit has now dropped to $441, and that's basically because the interest has dropped away.
That's the big one I see. The interest is the biggest expense with the investment property.
Well, every property would be positive without interest.
That's right, yes. Well, but you get a lot of clients going, I just want a property that doesn't cost me anything. But what they don't realise is they're taking an equity release out and they're borrowing over 100% of the property value and they want it to be positive. It's all like, good luck.
Yeah.
Unless you're buying at 10, 11% yield, your property early on while the rates are high. Different story when the rates were 3%.
Oh, so, massively different. Yeah, and we saw back in the heyday pre-COVID, big negative gearing. We used to see, look, if it was about 20 grand, you could get $18,000 negative gearing, 20 grand negative gearing. You used to see those sorts of numbers with your capital works and depreciation. During COVID, a lot of properties went positive 2,000 to 3,000 or even a couple $100, and people just didn't know. They couldn't comprehend it. They said, "What do you mean? I got a tax bill?" I said, "Yeah, because your interest has come down." But now the rate's back at 5-6%. We're getting they're not as negative geared, because what happened during COVID, a lot of people that held onto their properties were able to pay them down if you kept your payments up. So now they're coming out the other end. The rates have gone back up, but their loans are smaller. So they're now carrying – so negative gearing, I tend to see 10, 12, maybe $15,000 of negative gearing at the moment.
And I just want to raise this point. If we look at like scenario one, we've got partner A, like it's net rent, so they're behind, let's say, minus close to 10,000, and they get that tax benefit, the credit. They're out of pocket by what? Maybe just over $100 a week.
Yep.
Give or take. So when you're investing in property, you need to understand, okay, well, what am I saving every month? And before you buy a property, because if you've got a lavish lifestyle and you're not saving anything, and then you go buy an investment, your lifestyle is going to be impacted buying a property, because now this property is going to cost you an extra $115 a week that you need to account for. So I think that's an important point to make from a cash flow perspective. But instead of waiting till the end of the tax year, can you put it's a form that you fill in. I forgot what it's called, but do a lot of people wait to get their tax credit back every week, or do they wait for that lump sum towards the end of the year? Because I know a lot of people I like that big hit once a year.
Yep.
But I know after you've held a property for a couple of years, you can go fill in this form to the ATO and you can get that money back a little bit sooner, where they reduce your PAYG tax. Is that correct?
Yeah, so it used to be called a 221D variation.
Mm-hmm.
That's showing my age.
221?
221D. But now it's a PAYG variation. So basically what you do, you're filling in a tax return, how it would apply, how you think it would apply for the future. You send it off to the ATO and you say, well, I've got this job. I'm going to earn about this much. I'm going to pay about this much tax. I've also got this property and it's going to be negative geared. And so I think I'm going to drop $10,000 in negative gearing this year. So how about you recalculate my tax? And instead of my employer taking out the normal tax, they actually reduce how much they withhold. So you're getting your tax, instead of getting a lump sum tax refund at the end, you're just getting a little bit more in your net pay every week by week.
Okay.
So is it a good? There's no win. You don't make any more or make any less. It just means instead of getting a $5,000 refund at the end of the year, you'll see $100 a week in your pay.
Got it. I guess the advantage from it, if cash flow is a little bit tighter, the only advantage I would see to that is that extra $100 going into your offset every single week or whenever you do get paid. You offset a little bit. It's nothing substantial, but if cash flow is a little bit tighter, you might want that money back sooner than having to wait till the end of the fin year. So I know for some people it's forced savings. I know there's that $5,000 coming.
Yep.
Go on that holiday overseas or something like that. But yeah, good stuff.
Yeah. Well, what I see a lot with is I'll say to someone, if I give you $100 a week, chances are you'll spend $80 of it. But if I give you $5,000, you'll spend $500 and you'll happily go put $4,500 away somewhere.
Right, so forced diligence.
Yes.
Forced diligence.
Yeah.
Yeah.
And look, the more and discipline is 90% of the game here. So if you can get your tax benefit in dribs and drabs and use it to offset your principal residence during the year, do the maths on that over 25 years. It'd be huge.
Yeah.
And I guess the reason why we do this, and Jeremy and I have spoken a lot about it, is that there's no point holding a negatively geared property because it's costing you. You want to make sure that we're getting the growth within the property, because if the property is not growing and it's costing me, well, why am I investing?
Yeah, so that blue box, can you just scroll back to the left a bit?
So back to our example.
Yeah, so you would need, if you get only $6,000 capital growth, which is pretty terrible, you're breaking even. Well, inflation, you're actually behind.
That's right. So that's why, again, ROI is the key here. Now, we want to go to our third scenario, don't we?
Yeah, so the third scenario is the same as the second scenario, but instead of the 350 being split half-half at 175 each, this couple would have gone to the bank and said, our initial loan, the 650 loan, we want to get two loans. I'll get a 325 and you get a 325, and we each have our own repayment on those. And what we're going to do, person A, the person on the higher income, we're going to leave that at interest only.
That's me. I'll go interest only, Jeremy, and I'll go on the higher wage, and we'll put.
And then Jeremy, you're on P&I. So even though the loan's gone from the 650 down to 350, but what we've done, we've paid all that off Jeremy's loan. So Jeremy's now sitting on a $25,000 loan. So the total loan is still 350 between the two of you, which is the same as scenario 2, but the interest is now wildly different. So the person on the higher income, they still get their $9,700 deduction, which is the same as it was back in year 1, back in the blue box. Whereas Jeremy, you're now positive geared. So because you've paid so much off your loan, you're actually positive geared. And the important thing there is that so -9 and +8, they actually sum up to overall the property is still -1,500 between if we added up the two of you, which is the same as having the loan split by 2. But what happens is that, Dama, you're saving tax at a much higher rate than Jeremy is paying the tax on the positive. So that's where Damien's saving 3,800. Jeremy, you're paying $1,500, but overall, as a couple, you're saving $2,300. And just look at that number, just having the $350 loan split differently, instead of only saving $441 in scenario 2, you've actually got a pure cash tax benefit of $2,300. That's $1,900. And that's just 1 year.
So here we are, we're taking advantage of the difference in our marginal tax rates.
100%.
And all we had to do was shuffle around the loans.
Yeah, it just you just had to say to someone, instead of getting one loan together, how about we each get our own 50% loan?
Nice.
Interesting. We'd have to bring Alana on to talk about it, but Dom, you might be able to talk about it. So typically when you'll see these examples, will they have their loan statement and go, okay, I own 50% of the property, and they just apply that to their tax return, or will they have their individual loans for that one property? So that property, let's say it's 350, and then you've got these individual loans set up.
No, 99% of them will just be one loan for the for the couple. Yeah,
interesting.
Because it's just the easier way. One loan application, one offset account.
Easier for the brokers.
Yeah. Well, it's not a question that normally comes up because everyone's excited by the blue. Everyone's excited by the negative gearing, the blue area. Oh, you're going to save this much money.
But I guess for Jeremy, he wants to pay off the debt. So that's why we want to have it spread out. It's a little bit easier because Jeremy's strategy, he might be closer to retirement. He might want that positive cash flow sooner.
Yep.
He doesn't want to take the risk on, hey, I want to start 4 savings where I might have kept my loan as interest only at 325 and gone overseas, bought a new car. And that's where I see people get caught out. They think, I need an investment property, I want it P&I. But I'm like, well, you've got your owner occupier over there. Shouldn't you be paying that off first? Like move all that offset money. Any surplus goes into that offset because you want to reduce the non-deductible debt, don't you?
Yes. Yeah, for sure. I always look at, I call it like my after-tax interest rate. So your home loan might be 5.8%, 5.5%, but that you're paying that from after-tax money. So
Correct.
That interest is the after-tax interest. Even if you go and get an investment loan, it might be a percentage higher, call it 6.5%. But if I'm getting a 39% deduction of my interest, well, I'm not really paying 6.5%, I'm paying more like 4%.
4%, that's right. That's what people forget. They think, I need to pay my investment property off. So you see that a lot where they might have multiple properties and they're P&I on all of them. They've got their owner occupier plus their investments.
Yeah, a lot of the banks just sort of force them, or just not force them, but they'll just say, well, we just set up as P&I, that's the standard one, and then the person's caught there juggling 3 or 4 different loans.
This is the biggest mistake I see from a lot of investors by doing this. They don't ask the question, I just trust my broker. But they got to remember, it's easy for the broker. They won't give you this advice. They won't talk to it. They just want to get it done, next, move on, where you need to sit back and go, okay, well, what's the best for my scenario? I love it.
Yeah.
Good stuff. That was a special adventure. Is that
That's a special adventure. Yeah. Now, and just as a summary, I've got the gearing tab, just to highlight how gearing would work, because I've got an example. Yep, the first tab. So just to work through an example. So we've got an individual, they buy a property. Now we can change the variables here. So I've plugged some numbers in. Now the thing just to wrap your mind around here is that this is 2-year intervals. So everything's 2 years. So rent looks really high, but that's because it's 2 years of rent. All right. So we're not making 40 grand a year, we're making 20 a year. So the property value, so starting from the almost top, we're buying a property worth 500 grand. I'm saying the land component of that is 60%. So 300 grand of the 500 is land, leaving $200,000 of building.
And that's growing by 10%. So for example, we're saying not in the year, but over the 2-year period. So it's going from 500 to 550 over that 2-year period. So growing roughly at about 5%. per annum.
per year. Yeah.
Perfect.
So you'd see you guys would call that low growth. So
It is low growth, isn't it, Jeremy?
Yeah, that is low.
What's the what's the LTG
Oh,
last 10 years?
long-term national growth rate would be somewhere between 6-7%, depending on what you call long-term, 20 years, 30, 40 years.
So you don't know exactly. It's not like 6.47. You should know that off the top of your head. Every month when the new data comes out, you should know. All right. So we got the land value, 60%.
and we're gonna borrow 80%. So on the $500,000 property, we borrowed $400, and obviously assume that the rest of it came from deposit. Now we're renting that at a 4% yield. Jeremy, how does that sit?
That's not bad. It's a little below nationwide average, but it's pretty good for most of the large significant urban areas.
So really, we've got a rubbish property. 10% or 5% per year.
Yeah. You combine 4% yield and 5% growth. That's below average.
Okay, good. Interest cost 6.5%. Now I've got the land tax at nil, just saying that it's because it's under the threshold, and I'm going to allow 1% for other expenses. That's everything else: council, water, some repairs and maintenance. And again, $10,000 looks like a lot, but $5,000 per year.
Yeah.
Now the net rent, and I've made the sheet intuitive that it goes red and green, whether it's positive or negative. So the net rent there is $40,000 minus 62. You're losing $22,000. So that's the actual cash flow of what you're having to pay out. So that's equivalent to $11,000 a year. Call it $1,000 a month. Yep. Now, if you're on a 39% tax effect, so the ATO says, "Oh, well done, you lost $22,000. We'll give you an $8,500 discount on that." So after your tax benefit, you're really out by $13,000 across a 2-year period, and this is an interest only scenario as well. So the loan's not actually reducing. So just by rental growth alone, you can see that each year and I haven't paid anything off, but each year after my tax effect and my after income tax is starting to drop. It's starting to drop away. So drop away is in the negative is dropping away. I'm slowly going from negative geared to neutral and into positive territory. Okay. Now, if you go back up to the top, as you start to swing along, we can see where the green converts over to red. Now, I've used green because people want negative gearing. So they would see that as, oh, that's good. I've lost money. I get a tax benefit. Once you step from years 10 to 12, it starts to turn positive. Now, importantly, I haven't paid anything off. My borrowing is still $400,000. My property is now worth $885,000 in year 12. And as long as my rental yield is still 4%, just by the rental growth alone, my interest hasn't changed. My expenses have gone up, the 1% that I'm allowed for. But in year 12, just mainly through rental growth, I now have a positive geared property. So I'm not paying anything off. I've done the right thing that they say, don't pay it off for interest only. I've done the right thing, but I'm now starting to pay tax. And you can see how it starts to really elevate beyond that. Now, from a retirement perspective, this is what you want. You actually want a property to be returning income to you because you can't live off negative gearing. But I just thought it was interesting to see how it actually moved from negative geared to positive geared through years 10 to 12 on what we previously called a fairly low performing property. Now, if you can go and change those values, Dave. And if you said, now what value of growth do you want to put in there? Instead of 10%, what do you want to put in?
Let's go 15. So 7.5% per year.
Right, and that would just bring forwards when it goes from negative to positive, just due to the fact as to how fast rent will rise, being in line with the price.
It's a really good point because as markets, when we do our research, suburbdata.com.au, you can go there. Bit of a plug there for our website, Jeremy. But you can look for markets that have had solid rental growth over the last 1 year. Like, for example, when Perth went through their massive run, like rents were skyrocketing, as was the growth. So you can find markets like this. And this is the goal. This is the ideal: growth and income increase.
Yep.
And one important point here, if you are just buying your one property, look, for a lot of people, I would think if you've got your owner occupier and you've got one solid investment that's ticking along really well and you've got your super, you're going to have an okay retirement, aren't you? You don't need this 3, 4, 5, 57 properties. Like one decent investment property can really set you up because what you can do is you're showing that that it's interest only, but if you're diligent with your money management, you can have an offset account attached to that, and any surplus money you've got from your employment, you can plug in, and this will effectively reduce the amount of interest that you're paying. So your property will go positively geared a lot sooner. And then this is when you can talk to an accountant and go, okay, well, if I'm near retirement, maybe I'll keep that negatively gearing in my name, but then maybe I'll move a bit of money into my super. I'll get some tax benefits there, which we'll talk about in later episodes. But this is all about strategy and putting it all together.
Yep.
But yeah, really good scenario. But they're my big things. I think the offset account can help. The interest rate is the other big variable. So again, with the rates dropping, that's going to help the property go to cash flow a lot sooner. They're most probably the two big ones, aren't they? And maybe the tax rate, like if you have time off work or you earn more money, that can also affect.
Yes. Now, I've also built in, there's a loan repayment box there. If you were to deem and say, I am going to try and pay this off. So at the moment, there's the net cash flow at the bottom would be after tax. But if we go and put a figure in there, say let's pay off, I don't know, $1,000 a month would be $24,000. So negative 24.
Mm-hmm.
Going to pop
Close
three.
enough.
Yeah. So we're going to pay $24,000 off a year, equivalent to $1,000 a month. So now we've got the perfect storm where the value's going up, so the rent's going up, and we're also paying it off. Now, it did also, I didn't keep an eye on it, but it did also drag that positive gearing start sooner rather than later. And now if you scroll down, I wanted to just highlight, this is what this would actually feel like. So in the first year, you're negative 13. You're negative geared, but the actual cash that you feel after your tax benefit would be 13 grand. After that, now not only are you losing your negative gearing, you're now also having to kick up $24,000 to pay the loan off, to start paying the loan off. So you're actually having to make do with $32,000 less in 2 years across 2 years of your life. But more importantly, what this also then highlights is that this number here, then next 2 years, you're losing $27,000 of cash. And this is after tax. This is what you'll actually feel. 27 becomes 22, then 16, and now it starts to ramp up the other way. So there is a point where a property is so positive geared, it's paying its tax and it's also helping you. So I'm not sure what K is, what year we're up to there. Probably like, there you go, 16 years in. You're still carrying some debt on the property. You've got $208,000 of debt at that stage, but it's actually putting $15,000 of income into your pocket after paying 24 grand off and paying the tax bill.
But it is restricting your cash flow early on. And this is where I see a lot of investors make a mistake. They're thinking, okay, I'm going to buy, let's say Melbourne example where the yields are lower. They think I need better cash flow, but all their current properties are all on principal and interest, so their cash flow is really restricted.
Yes.
Where if they had it as interest only, that's got their buffers up, and then they don't have to stress.
Yeah.
Really, that's the scenario, isn't it? And a lot of brokers would actually refinance a lot of that interest only after 5 years. But where you can get caught out with interest only loans is you're not a good saver. And if you've got that extra money there, you'll spend it. Where P&I is a forced saving. So I'm not purely against it. It just comes down to, what's your plan and your strategy? Where can I get the best ROI for my money while mitigating the least amount of risk?
That's it. Perfect.
All right.
Yeah, that's all the examples I have.
So,
Jeremy, you got anything to add?
no, that was good. Good insights. Thanks, Dom. Looking forward to the other ownership structures you're going to show us.
Excellent. So am I.
And I think the other thing is someone to be wary of as an investor is like, maybe your income, a lot of people's incomes are going to be stable, but it's more about, okay, as we said, if you're going to sell a property, do you wait down the track maybe when you're in a low income year, or you might take a gap year? So there's all strategies around that, and that's where they can talk to an accountant.
Yes. Yeah.
What's your accounting firm again, Dom?
So DPR Chartered Accountants, and we're in Norwest, just not far from Baulkham Hills.
All right, beautiful. We're looking forward to the next episode, so we'll leave it there for now. Thanks for tuning in, and see you in our next episode, Trust versus Companies, what investors need to know. Bye for now, and take care.